Money measurement. Money measurement is that money can be accurately measured solely based on the physical size or weight of the currency notes or coins.
No, you are telling the wrong explanation of this concept. Now I'm going to correct the explanation of money measurement. Money measurement is depends on the context and who you are communicating with.
Meaning of the dual accept is forcing duality where it doesn't exist, like applying dual aspect to the situations with only one valid perspective. For an example, calling the color of the sky dual aspect, like blue and yellow, wouldn't be the accurate because it is blue.
Telling the wrong explanation of this concept. Now I'm going to explain correctly about the dual aspect. The main key point of this concept is every financial transactions has two equal and opposite effects and on a business accounts. The next one, double entry accounting, records these dual effects into separate accounts. And last one is this concept ensures accuracy and completeness in financial statements. Next, conceptual cornerstone of this concept is debit and credits. It's like debit increase asset accounts and expand accounts while decreasing liability accounts, equity accounts, and revenue accounts. And also credit do the opposite. The point is the accounting equation is asset equals to liabilities plus equity. This one is this equation ensures balance in double entry accounting. Example, buying equipment for cash, paying a supplier, and receiving payment from a customer. The benefit of the dual asset concept is prevent errors and omissions. It's like ensures every transaction is recorded completely. Second one is detects fraud. This one is discrepancies highlight potential issues. One provides a clear financial picture. This one is traces the flow of resources and obligations. Understanding this concept is essential for accurate financial reporting, sound financial decision making, and also compliance with accounting standards. Additional insight of the concept is double entry accounting is the foundation of modern accounting system. Next one, the dual aspect concept is used in all major accounting frameworks, including GAAP and IFRS. The last one, even simple transaction like buying a cup of coffee have dual aspects.
Realization occurs when the holdings of an account are sold off by the brokerage or investment firm where the account was created. In most cases, this is done to satisfy margin requirements. When you sign up for a margin account with a brokerage firm, you grant that the legal right to realize your holdings if you are unable to meet the account's requirement.
So today I just want to explain you what is realization in accounts. So realization in accounting refers to the process of recognizing or refunds or gains when they are earned in occur even if the actual cash hasn't been received yet. So yeah, this is
Accrual. Accrual, that is, the revenue is recorded when the cash is being received and the expenses is recorded when the cash is only being paid.
No, that's a wrong explanation. Actually, the accrual basis holds that the revenue we earn and the expenses we bear are recognized at the time they take place and not at the time they are actually paid for, which may be several months later. For example, expenses accrued but not yet paid in current period should be treated as accrual or accrued expenses under current liabilities.
To explain about business entry concept. Business entry concept means blending personal and business finance. It's like don't playing the separation between honor and business funds, implying it's okay to commingle them for finance. This can be to incorporate record keeping and legal issues. After that, ignoring legal sections, failing to differentiate between sole proprietorships, partnerships, and corporations, implying the concept applies equally regardless of legal structures. This can lead to incorrect assumptions about liability ownership. And then business entry potentially harm a business financial health. So the business is can problem solve lastly and also is very stressful concept one. So that's why some of the people never choose the business entry concept because it's always problem for the business entry.
Oh no, you're wrong. Definition of business entry is a written document or a recorded during a company's normal operation that can be used as a evidence in the court under the business recorded rules exceptions to the Hersey rules.
Stable money means avoiding prolonged periods of excessively high inflation or deflation. Inflation is a rise in the general price level of goods and services. It's an economy over a longer period of time, resulting in a decline in the value of money and purchasing power.
A few moments later.
No. Okay, so here what is stable money stands for. The stable ringgit assumption, then its underlying accounting principle where the definition of the ringgit will remain constant across the fiscal period. Then the inflation rate is assumed to be zero as well. So here the one example that is stablecoin, which is a type of cryptocurrency that is designed to minimize price volatility by pegging its value from another asset, such as fiat currency or commodity. So that is what stable money stands for.
I'm going to explain about time interval concept. Time interval concepts are always absolute and consistent regardless of the observer's frame of reference. In reality, according to the theory of relativity in physics, time interval can be perceived differently by observers in different frames of reference. This means that time is not absolute and it can be affected by factors such as relative motion and gravitational field. Oh no, you are given the wrong statement. A true statement about time interval is that time interval concept is used to divide the continuous flow of a company's financial transactions into specific periods, such as months, quarters, or years. This allows for the preparations of financial statements such as income statements and balance sheets. To provide a snapshot of the company's financial performance and position during a particular time interval. An example, a company records its transactions from the 1st January to 30th June every year and closes its books of accounting periods is that of half year.
Today I just want to share what is objectivity in accountancy. So So yeah, this is what in my opinion. Okay, so objectivity in accounts isn't always attainable. Personal biases can influence the reporting of financial data and despite attempt to remain impartial. So this is from me. Bye.
Here, what is objectivity? Objectivity approaches situations and informations without any personal bias or subjective influences, striving on assesses and interpret based on facts, evidence, and impartial analysis. For an example, objectivity can be found in scientific research. When conducting experiments or studies, research aim to gather all the analyzed data in neutral or unbiased manner. So that is what objectivity meant to be.
Historical cost. Historical cost is that it always reflects the current market value of an asset. In reality, historical cost measures the original cost of acquiring an asset, which may not accurately represent its current value due to factors such as inflation, changes in market conditions, and depreciation.
Oh no, that's wrong. The correct explanation is the historical cost concept stipulates that all assets must be recorded at the original cost and not the asset's current market value. Historical refers to the price or the actual cost we pay for in the first place. For example, the cost of fixed assets is recorded at the date of acquisition cost. The acquisition cost includes all expenditure made to prepare the asset for its intended use. It included the invoice price of the assets, freight charges, insurance, and installation costs.